Welcome, everyone. In the next 45 to 60 minutes, we're going to introduce you to something CMG Financial calls the smarter way to borrow. And by the time we're done, you're going to understand exactly why that isn't just a slogan. Whether you're a realtor trying to give your clients a competitive edge, an investor building a portfolio, a homeowner tired of sending a check to the bank for 30 years, an insurance agent looking to add value to your book of business, or a financial advisor who wants stronger clients with better cash flow, this changes the game. My name is Joel the Mortgage Guy, and I'm joined by Drew Johnson. Before we get into mechanics, the headline. 4 things this loan does that a traditional mortgage simply cannot. You spend less on housing debt, not a little less, potentially hundreds of thousands less over the life of your loan. You own your real estate years earlier, 5 to 7 years instead of 30. You access your equity anytime, not when the bank decides you can refinance. 24/7 access for 30 full years. And you fund other financial goals, investment properties, college tuition, business opportunities, without starting over from scratch. We're walking through all 4 of these today, so stick with me. Quick acknowledgement, multiple groups in this room today, and I'm going to speak to all of you. Realtors, you want tools that make you stand out. You want to be the agent who gives clients a strategy, not just a transaction. This is that tool. Investors, you understand leverage. You know wealth is built using other people's money intelligently. This product was designed for how your brain already works. Homeowners, you're done watching the bank get rich on your mortgage payments for 30 years while your balance barely moves. This is your exit ramp. Insurance agents and financial advisors, stick with me. I'm going to show you exactly how this creates better clients for your practice and a stronger referral relationship than anything you're doing right now. Pay attention to the parts that speak directly to you, but stay for all of it. Let me start with some numbers, and these are real eye-openers. 84% of buyers finance their home purchase. 62% of households carry at least one mortgage. 90% of all loans in America are 30-year forward amortizing structures. That's the traditional mortgage, and it's producing $12.2 trillion in U.S. housing debt. Not billion, trillion. Here's the one that should bother everyone in this room. 50% of American households are not saying enough to maintain their standard of living in retirement. These two numbers are directly connected. When 42 cents of every household debt dollar goes to mortgage payments, there's nothing left for actual wealth building. We've built a system where you spend 30 years paying a bank instead of 30 years building a portfolio. And that's the problem. The velocity banking strategy and the products built around it is the solution. Look at this timeline. Average first-time buyer, 33 years old. Average all-in home buyer, 47. Average mortgage borrower, 55. Retirement hits at 64, life expectancy 77. Here's what's happening in between. You're paying for college, dealing with your parents' health care, going through recessions, and the whole time a 30-year mortgage is pulling money out of you every single month. The traditional mortgage doesn't just cost you money. It competes with every major financial priority you have from your 30s to your 60s. The question isn't whether you can afford a mortgage. The question is whether you can afford a 30-year one. Here's the math nobody shows you at the closing table. By year 10, after a decade of payments, for every $100 you send to the bank, only $23 goes to your actual principal balance. $77 goes straight to interest. By year 21, you still owe 50% of what you originally borrowed. On a $500,000 loan at 6.5%, you'll pay over $637,000 in interest alone over 30 years. Your $500,000 home just costs you over $1 million. That's not an accident. That's how amortization was designed in the 1930s to front load the bank's profit. You're servicing their income before you're building your equity. Now let me show you what happens when you flip that model completely. This is what month 1 looks like on a traditional mortgage. You sent the bank $3,160. $452 of it went to your actual balance. $2,707 went to interest. One full payment in, and you still owe $499,547. Read that again. You paid over $3,000 and your balance dropped by $452. That's not a bug. That is the design. The bank collects the most interest when your balance is highest, which is the beginning of your loan. So they engineered it to take their money first every time for years. This is why people call it the amortization trap. You're not paying off a loan. You're paying rent to the bank with the option to eventually own the house 30 years from now. To be fair, traditional mortgages aren't evil. They have real advantages: low down payments, familiarity, wide availability, predictable fixed payments. But look at the cons. Slow, takes decades to repay. Inefficient, you're paying interest first, always. Rigid, you can't access your equity without refinancing. Expensive, even at so-called low rates, the total cost is enormous. These aren't opinions. These are structural realities of a product designed in the 1930s for a banking system that needed a reliable revenue stream. It was built for them. The velocity banking strategy was built for you. This is one of the most important slides in this entire presentation. Most people compare mortgage options by looking at the rate, 6.5% versus 8%. And on paper, lower rate wins, right? Wrong, because rate is not cost. At 6% over 30 years, for every $100,000 you borrow, you pay $116,000 in interest. That's a 116% relative cost. Even at 3% COVID era rates, nobody's seeing again, you're still paying 52% on top of what you borrowed. The first lien HELOC velocity banking product has a higher stated rate, 8%, but the velocity banking client is paid off in 5 to 7 years. Their total interest cost is a fraction of the 30-year borrower. 3 variables define what a mortgage costs to you: rate, principal, time. Velocity banking attacks all 3 simultaneously. Stop looking at the rate. Start looking at the total cost. So what exactly is this product? CMG Financial developed the all-in-one in 2005. It is one of the products in the market built specifically around the velocity banking strategy, and it's the product we're presenting today. I want to be clear about something. CMG is not the only lender that has a built product around this strategy. There are other institutions offering first lien HELOC products with velocity banking capability. What that tells you is that this isn't a gimmick from one company. It's a legitimate market-validated strategy that multiple lenders have built products around. Today, we're walking through CMG's version of the all-in-one loan. In plain English, it is your mortgage and your checking account combined into one account, one login, one balance. Your paycheck goes in, your bills go out, and your mortgage balance gets attacked every single day by whatever cash is sitting in that account. Available up to $3 million, covers primary residences, second homes, and investment properties. Full banking platform included, ATM cards, checks, online, and mobile banking. Here's the mechanic that makes everything work. Traditional mortgage interest is amortized, pre-calculated, front-loaded, and you can't change it no matter what you do with your money. The velocity banking first lien HELOC charges simple daily interest. The formula, your nightly principal times your rate divided by 365, your daily interest charge. Every morning, your interest resets based on your actual balance from the night before. So if your paycheck hits on the first of the month, your balance drops immediately. Every day that money sits in the account, you're paying less interest, starting the next morning. Bonus most people don't know, your monthly interest isn't even due until the 21st of each month. Your income keeps working against the balance for 20 extra days every single month for free. Compounding used to work for the bank. Now it works for you. The strategy that ties it all together, velocity banking, not complicated, just requires discipline. Step 1, deposit your paycheck directly into the account. Balance drops immediately. You're already paying less interest. Step 2, use a rewards card for all monthly expenses, groceries, gas, utilities, subscriptions, everything. Step 3, earn travel points or cash back on every dollar you spend. Step 4, before that credit card charges you interest, usually about 21 days after your statement closes, pay it off using your first lien HELOC. No credit card interest, ever. Step 5, your income has been sitting in the account the entire time, reducing your balance daily. Step 6, repeat every single month. The result, Mortgage paid off in 5 to 7 years without changing your monthly budget. Not a gimmick, math. Here's the part people don't expect. When you're running all your monthly expenses through a rewards card and paying it off before interest posts, you're earning airline miles, hotel points, or cash back on every dollar. Your cost to earn those rewards, the simple interest on your HELOC for the few days that balance was outstanding, essentially nothing. Run $3,000 a month through a 2% cashback card, that's $720 a year in free rewards, with $0 credit card interest costs. The bank used to get paid first, now you do. Your mortgage is paying for your vacations. Let that sink in for a second. Realtors, investors, and financial advisors. This slide is for all three of you. Lean in. Here's the play. You draw equity from your first lien HELOC and use it as a down payment on an investment property. That HELOC draw, when used for investment purposes, may be classified as investment interest, which is potentially tax deductible. Now add to that the mortgage interest on the investment property itself is generally tax deductible as a business expense, and the property itself is a depreciable asset, generating additional deductions that can offset other income. So you've potentially deployed tax advantage capital from your primary residence into a cash flowing asset with deductible debt on both sides and depreciation on top. Financial advisors, this is exactly why the strategy creates stronger clients for your practice. After tax cash flow means more investable assets for you to manage and grow. Important, and I say this every time, consult your CPA or tax professional for your specific situation. These are potential advantages worth exploring, not guaranteed outcomes. Here's a feature that gets overlooked. And it's one of the most powerful parts of this product. The all-in-one has a 30-year draw period. The first 10 years, full access to your credit line. And it steps down through year 30. With a traditional mortgage, your equity is locked. You want access to it. You refinance, pay closing costs, reset your term, start the interest clock over. With this product, say you pay off your balance in 7 years, you still have 23 years of access to that equity line remaining. Pull it for college tuition. Pull it for a rental property down payment. Pull it for a medical emergency. Use it, replenish it, use it again. Your home isn't just where you live. It's a 30-year revolving financial platform. Here's what the payoff looks side by side. The red bars, traditional mortgage at 6.5%. Year one, still owe $492,000. Year three, $475,000. Year seven, still $433,000, still paying 23 years from now. The teal bars, Velocity Banking, first lien HELOC, year one, already down to roughly $440,000. Year three, about $310,000. Year five, around $160,000. Year seven, zero, done, paid off. And here's what the traditional mortgage borrower is doing while the Velocity Banking client is mortgage-free, still mailing checks for 23 more years. Take a picture of this chart. This is the entire argument in one visual. For the investors and realtors, this is the BRRRR method supercharged. Buy, renovate, rent, refinance, repeat. You draw from your first lien HELOC to fund the purchase and renovation of an investment property, your equity working as acquisition capital. You rent the property, rental income helps offset the cost of the HELOC draw. Refinance the investment property once stabilized, use those proceeds to replenish your credit line. Now it's fully replenished. You do it again. Your primary residence becomes the funding engine for your entire investment portfolio. You're not saving up cash between acquisitions. You're cycling capital continuously for as long as the 30-year draw period is active. This is how people go from one property to five without winning the lottery. Realtors, your specific takeaway. The agent who teaches clients a strategy creates clients for life. And here's the math. Client pays off their mortgage in 7 years instead of 30. They buy a move-up home, that's one transaction. They buy an investment property using BRRRR, that's another. They refer their colleague, that's a third. One client relationship, multiple closings, all because you showed them something your competition wasn't talking about. The realtor who builds wealth, not just sells homes, doesn't chase referrals, they generate them automatically. Be the agent who changed someone's financial trajectory. Word travels. Let me be completely straight about who qualifies and honest that not everyone will. That's by design. The CMG all-in-one loan is manually underwritten. Every file gets human eyes, follows Fannie Mae, state, and federal ATR standards. That means strict. DTI cap is 43%. If LTV is above 80%, DTI drops to 40% max. Reserves, defining this in a moment, minimum 10% of the loan amount, verified liquid assets after closing. LTV up to 90% for purchase on a primary residence up to 1.5 mil with a minimum 720 FICO, cash out up to 80%. Bank statement documentation available, huge for self-employed borrowers who can't show traditional W-2 income. All past due taxes must be completely resolved before closing, 0 exceptions. The reason the bar is high is because the product is powerful. This is not a loan for marginal borrowers. This is a loan for disciplined people who are ready to use it strategically. Reserves confuse people, so let me be crystal clear. Reserves are not your down payment. Reserves are not your closing cost funds. Reserves are what is left in your verified liquid assets after you've already handed over the down payment and paid closing costs. On a $500,000 loan at 10% reserves, you need $50,000 sitting in your accounts after close. At 15%, $75,000. What counts? Cash, checking, savings, investment accounts, retirement accounts at 60 to 70% of their value. What does not count? Money you're using to buy the house, closing cost funds, most gift funds, assets you're liquidating just to get to the table. This reserve requirement is the lender saying, we want to know you have a financial cushion. It protects you as much as it protects them. Full LTV matrix directly from CMG. Primary residence up to 90% LTV on purchases up to 1.5 million with a minimum 720 FICO. As loan amount goes up, LTV steps down. At 3 million, you're at 70% LTV. Second homes max at 80% LTV with a minimum 700 FICO at lower loan amounts. Investment properties, 70% LTV, minimum 720 FICO. Max loan 1 million, max cash out 500,000. Know these numbers cold. Your clients will ask immediately after the presentation. Photograph this slide right now. This is the one you'll reference later. The all-in-one has a higher stated rate, 8% versus 6.5%. Without context, traditional mortgage wins. Wrong. Over 30 years, the traditional mortgage costs $637,000 in interest. Over 7 years, the traditional borrower has paid roughly $220,000 in interest and still owes $433,000. The Velocity banking client over those same 7 years paid $80,000 to $120,000 in interest, owes zero. CMG's own data, clients pay down their balance 2 to 4 times faster without changing their budget. The stated rate and the effective rate are two completely different numbers. Learn that distinction. It changes every conversation you have about this strategy. When we present this to realtors, we hear the same 5 objections every time. First one being, my client can't afford a higher rate. I hear this one the most. 8% looks higher than 6.5% on paper. But go back to slide 25. The client at 8% using Velocity Banking pays less interest in 7 years than the traditional borrower pays in just their first 7 years at the lower rate. It's not about the rate, it's about the total cost. Those are two completely different conversations. The second objection, this sounds too complicated for my client. It sounds complicated until it doesn't. CMG has a free interactive simulator at allinOneLoan.com. Your client puts in their own numbers and sees exactly what their payoff looks like. Once they see it visually, the light bulb goes on. The first month is the learning curve. After that, it runs on autopilot. The third objection, my client doesn't have enough reserves. Then it might not be the right product for them right now, and that's okay. We'll tell you that in the first conversation, not at the closing table. But it opens a planning discussion. Here's where you are. Here's where you need to be. Here's a 12-month roadmap. That conversation puts you in a completely different category as a realtor. The fourth objection, I've never heard of this loan. Most agents haven't. which is exactly the competitive advantage for the people in this room right now. CMG developed this in 2005. Multiple lenders now offer similar products. That tells you that this isn't a fringe idea. It's a legitimate strategy that the market has validated. You're one of the early movers bringing it to your clients. A Velocity banking client who's been paying down aggressively for 3 years has so much less principal that the rate conversation becomes almost irrelevant. Let me walk you through exactly what onboarding looks like after you close. Pre-closing QA check to confirm expectations. No surprises at the table. 48 to 72 hours after closing, CMG sends a congratulations packet electronically with full account setup instructions. 2 to 4 weeks post-close, ATM Visa card arrives. Routing and account numbers established. Online banking and mobile app go live. Ongoing resources at allinOneLoan.com, training videos, brochures, interactive simulator, live webinar series. This isn't a loan you get and forget. It's a system you plug into. Let me direct about who this is built for. Homeowners serious about paying off their mortgage in 5 to 7 years, not talking about it, doing it. Self-employed borrowers who qualify in bank statements. Investors running BRRRR or buy and hold strategies who need a revolving capital source. Disciplined borrowers who can manage a monthly cash flow system consistently. This rewards discipline. Buyers with 10% or more in reserves post-close and a FICO of 720 or higher. And anyone tired of paying $637,000 in interest on a $500,000 loan who is ready to do something about it. If you're in any one of these categories or you know someone who is, we need to talk. Here's your action item, and it's simple. Text me or DM me the word Velocity, VELOCITY. We schedule a quick call. I run a qualification review, DTI, reserves, LTV, FICO, and within one conversation, you'll know exactly where you stand. No pressure, no pitch, no commitment, just clarity. If you're a fit, we build your custom Velocity banking roadmap, your income, your expenses, your goals, a real personalized strategy. If you're a realtor, insurance agent, or financial advisor, text me Velocity and let's talk about how we structure a referral relationship that works for both of us. I'm licensed in Illinois and work through my partner network at BRRRR Financial across 49 states. Wherever you are, we could have this conversation. Text Velocity now while you're still thinking about it. Thank you all for being here. Genuinely, if nothing, take 2 things from today. The rate is not the cost, and your home can be a wealth-building engine, not just a place you live. Realtors, most powerful thing you can do Monday morning is text me Velocity and tell me about one client in your pipeline this applies to. Insurance agents, every homeowner or client you have is a potential referral conversation. Text me Velocity and let's talk about what that looks like. Financial advisors, if you want stronger clients with better cash flow and real assets already working, text me Velocity. Let's build something together.
If you'd want more content like this, hit like, subscribe, and hit the bell for more.